What's up, good people? It is Friday. That's my day. Friday, September 4th, 2020. You are talking to your boy, Charles Tank Harris, CEO and founder of the financial planning firm Wealth Our Way, and I'm bringing you 15 minutes of finance. I'm glad that you're joining us for the fifth installment, the final finale of the series, Building Wealth from Scratch. I had such a good time doing this week that I'm probably going to plot out and plan future lessons and series based on week-long platforms, so that we can break a little bit of the information down on a daily basis and not overload too much at one time, because even this 5-part series, I've had to skip a lot of information. I realized yesterday that I never brought up commodities in the asset allocation. So I do want to talk about commodities because it's important to understand where gold, where wheat, where other commodities, and I don't go into all of them because once again I don't want it ever to come across as I'm suggesting a particular investment or asset, but where all of these different opportunities and options can fit into a portfolio. So it's 12:30 on the dot. I'm ready to rock, and we are going to start this thing off talking about the 5th installment in our series, which is the passive or managed mutual fund. Which one is right for you, what both mean, what opportunities, what costs, what restrictions, where they fit in your portfolio. A lot of people do not understand the difference between a actively managed mutual fund and a passively managed mutual fund. So we're going to start with passively managed. What does that even mean? Well, a passively managed mutual fund is 90% of the time what is deemed as an index fund. So once again, an index is a basket of securities, whether they are stocks, bonds, or commodities. It's a basket of securities that measure a broad-based collection or a broad-based market. The most common one that, if you follow finances at all, that you hear about are the two: the Dow Jones Industrial Average and the S&P 500. The S&P 500 is normally what people are speaking about when they say the market. Another one that's very popular nowadays is the NASDAQ. So these are the three major American stock indices. But there are many, many more. There are the Russell 1000, Russell Value. There's the MISCEs, the European and Eastern Asia different funds. There's so many different, the Lehman bond one, the gold. There's so many different indices that will allow you to track what a particular sector or group of assets are doing. And that is really what active managers compare themselves to. So when you have an active management mutual fund, which I'm going to get into in the second part of this conversation, they all follow a certain group. And once again, I like to use analogies. They work very well when we're trying to learn. So think cars, think automotives. When you think of an automobile and you're going to buy one, you could look at a Range Rover or a Ford Explorer. These are both SUVs, but Range Rover is in the luxury SUV class, and the Ford Explorer is in the more common SUV class. Then you would have something like the Ford Escape. Now I'm all on Ford right now because I can't. Let's go with the Toyota RAV4. So the Toyota RAV4 would be in the compact SUV class. So you wouldn't compare these three SUVs to each other. You would compare Range Rover to the Mercedes SUV. You would compare the Ford Explorer maybe to the Chevy Tahoe. And you would compare the Toyota RAV4 maybe to the Ford Escape. All of those comparisons fall under what we would call a grouping. In the equity and bond and commodity world, we call those groupings indices. We say, hey, the S&P 500 measures the 500 largest American corporations. So if you are a mutual fund manager and you are claiming that you are a large cap, we talked about cap yesterday, a large cap mutual fund manager, then you would compare yourself to the S&P 500. It wouldn't be fair for you to compare your returns to, let's say, the Russell 1000 value, which is more of a smaller index. That brings up a very valid point, which we'll talk about in a future 15 minutes. I have worked in every area of finances. So the last area that I worked at a company with was with New York Life Insurance Company, and I learned a lot about the tax-free blessings that insurance brings about. One of the things that I often found odd when I would talk to people, because everybody has their own level of financial acumen, was when people would say, hey, I don't want to buy an insurance policy that has cash value, it's a bad investment. And I would explain to them, it's not even an investment. It's not regulated by the SEC. It's not an investment. It's more of a savings vehicle. And yes, you should outperform your life insurance policy with a mutual fund that's invested in stocks, because we're talking apples and oranges. So that's a great example as well here as to how you compare two things. So going back to passive index funds, when you decide to buy the S&P 500 index fund, and many different houses, we talked about houses, rooms, and furniture. So Vanguard would be a house, Fidelity would be a house. These houses all offer this S&P 500 index fund. The job of the person managing the S&P 500 index fund, one job. They got one job. They need to make sure that their mutual fund that is being marketed as the S&P 500 fund actually mimics the real S&P 500. So if on a particular day, Exxon makes up 1.2% of the S&P 500, Exxon better make up 1.2% of the S&P 500 index fund. So it's not like it's not managed at all, and that's why I keep making the distinction between passive management. There is still a manager who's responsible for buying and selling to make sure that that advertised mutual fund actually does match up to the index that it's named after. What is the benefit of being in a passive fund? Well, this passive manager does not have to have the same skill level as an active manager, because they're not holding themselves out to be an expert picker of stocks or bonds or commodities. They're simply steering the ship and making sure that the sales and the purchases inside of the S&P 500 fund that they're passively managed matches the index. As a result, they don't earn as much money as a private, actively managed mutual fund manager earns. They're not paid as high. And because they're not paid as high, the expenses are not as high inside the fund for you. And if the expenses are not as high, that saves you money over time. Hey, Andrea, how are you, love? That saves you money over time. So the reality is that a lot of people pick index funds for a couple of reasons. The primary reason is they want to save money on their investment portfolio. They don't want to pay a manager fee, a high manager fee. Now, here's something, this is not something that's an opinion of mine. This is something that has been historically supported through data. It is very rare to find an actively managed fund with a fund manager that consistently outperforms the index that it is compared to. So that's another reason people buy passive funds. They say to themselves, hey, why am I paying this manager if over time he's not even going to outperform the index that he's compared to or she's compared to? Why would I pay an extra 1.5%, 2% in expenses for something that ultimately, when I look at it over a 30-year period, the S&P 500 returned me 10.2%, and the active fund after expenses returned me 9.7%. I paid money to make 0.5% less. So in that instance, a lot of people opt for no sales charge index funds so that they can build a portfolio based on their risk tolerance. We talked about that earlier in the week. And then they put together either exchange traded funds, which we will talk about next week, or index mutual funds to build a low cost portfolio. Let's jump over to actively managed, because the question has to be, well, Tank, that's a compelling story you make over there. Why would anybody buy an actively managed fund, especially if it's more expensive? Well, I said that it's rare that a manager beats its index over time. I didn't say that it never happens. And at the end of the day, we as people, and you guys are sitting out there watching this, you guys want to make money. At the end of the day, I get calls every day. Trust me when I say every day, somebody calls me with this idea of what they can do to make a bunch of money in the stock market or bond market or commodity market or Bitcoin or whatever the soup du jour is. So when I get those calls, first of all, Big Tank is not a stock picker. I never have been. I've been in this business for 22 years. I don't believe, me personally, this is not something I'm forcing on you, I don't believe you get wealthy trying to go out here and find what the next big thing is going to be. And I'm going to talk about that at length next week. I'm going to talk about why the key to building long-term sustainable wealth is building an asset allocation based index fund portfolio or an actively managed portfolio if you choose to go that route, dollar cost averaging into that portfolio and rebalancing when time calls for it. It is the most boring way to become a millionaire, but over time you will become a millionaire. If you want sexy, scintillating, exciting, something you can brag to your friends about, working with me or listening to me probably isn't going to do it for you. I'm not about that excitement. I'm about that making money. So over time, buying a diversified portfolio, averaging your money into it, keeping an eye on your costs will make you the goals that you want come true. So active managed funds. When I first got into the industry 22 years ago at Smith Barney, there's going to be a quiz on this one day, and if somebody forgets how long I've worked in the business or where I started, we're going to rumble because I say it every time I talk. When I first got into the business, Fidelity had a huge mutual fund called the Magellan Fund. And it was run by a guy named Peter Lynch. And he was considered to be the Don Dada, the grand poobah of managing people's money. And the Magellan Fund kept growing and growing and growing. And it seemed to every year outperform the market. Where's the Magellan Fund at now? I truly don't know, but I would challenge you guys to Google it and see how they've held up over the last 22 years. My guess is they're not outperforming the broad-based market still because it is a very difficult task to do that for decades. At the end of the day, there's a big disadvantage for successful mutual funds, and you're going to learn it here today. So I want you to be aware of it. This is not to dissuade you from buying a mutual fund. A mutual fund has a lot of advantages, but there's one: success brings challenges to the fund manager, because think about it this way. Fund manager decides, hey, I'm going to go here. I think I'm smart. I know a lot about big American companies. I have relationships with CFOs and the boards of directors. I can really find out what's going on, and I can find out how to manage and look at the public financials and see if I can build a portfolio that beats the broad-based market over time. So they launch their fund. And guess what? They're successful right out the gate. They do triple what the market did that year. People are starting to look at them like, okay, they're over there making this money for us. Next year, they do triple again. Well, it's a wrap. I want you to know that the way people chase money in this country, this guy's going to, or girl is going to get a bunch of requests to take money into his or her fund. Now, here's the rub. When you're a mutual fund manager, you buy a certain number of stocks based on the asset class. Hey, Vicky! My girl Vicky is here. I love it. So when you're a mutual fund manager, you buy your portfolio based on what? Your best picks. Now, let's say that this particular fund has 30 securities in it. That is this manager's best picks. And they own these 30 securities. They keep some cash on hand for when there are buying opportunities. Sometimes the securities will reach their mark and they'll sell some things. But for the most part, they want to own these 30 securities. Well, guess what happens when $20 million more money comes in from outside investors? If they don't buy securities with it, then they have too much cash. If they have too much cash, we talked about the rate of return expected on cash is down at the 1% level. It will bring down the overall portfolio performance because they'll have a higher amount of cash than they actually have stocks in the portfolio. The performance will suffer. So this advisor has to spend the cash. Now, the short answer people would think is, buy more of what they own, buy more of these positions. Well, they don't always do that, and there's reasons for that. If they were tripling money for the last 2 years, what do you think happened to the stocks that were in their portfolio? They went up. Hey, Dawn, they went up. Now those stocks are expensive. They were a good buy 2 years ago, and they're still good to hold. But if I got new money, I may not want to place it in these stocks. So what do I have to do with this 20-some million bucks? I got to go to my picks 31 through 50 now. Now, as a customer, you aren't getting the best picks that I have. You're getting the second best picks that I have. You're getting my B team. My performance will most likely suffer because I'm not picking the ones that I thought were the best. I'm picking my backups. And the more money that comes in, the further down the backup line I have to go. So you start to see that success brings challenges for fund managers to continue. That's another reason why a lot of fund managers have a hard time sustaining beating their index. They could still be very good managers, but they end up having this situation where they have so much success, money comes in, now they have to buy their second and third and fourth choices, or they're holding on to too much cash, and it becomes a problem. So when you're looking at the difference between an actively managed and a passively managed mutual fund, you have to make the decision, and you can go on wealthourway.com. You could have some more financial literacy brought to you. You can inbox your guy, Big Tank here, and ask the questions that pertain to your portfolios and get unbiased, non-security based advice as to where you should be looking to allocate your future dollars. So that wraps up the 5th segment of Building Wealth from Scratch. I am so happy that you guys were here. Almost every face that I'm seeing check in has been here all week. Next week, we're going to start a new series. I challenge and ask, and my favorite word, I implore you guys to inbox me, to put information on the site in the contact us forms, and give me your questions. I can talk about finances all day. I love to do it, but it makes more of a value proposition for you sharing your lunch break with me if you ask the questions that you want answered. I spent a great part of my career being my client's advisor's advisor. They had their money at a certain firm. They loved the person they were with. They didn't want to leave, but they didn't always trust that the information they were getting was unbiased and in their best, their best situation. So they hired me to watch this person. I'm getting paid a flat fee over here to make sure the person that's getting paid on the assets is doing the right thing by the assets. It may seem like an unnecessary additional expense, but it saved my clients a lot of money. I found a lot of errors. I found a lot of overcharging. And more importantly, it gave the one thing that we're all trying to get in life, peace of mind to the clients. So I want you guys to have the greatest weekend. I love doing what I do. I love doing it for you. I want you to come back next week, Monday at 12:30, where we'll start a new series on 15 Minutes of Finance with your guy, Charles Tank Harris, Wealth Our Way. You guys have a great weekend.